Welcome back, everyone. This is the Mortgage Sensei here. Today, we're going to talk about the loan estimate. First, let's talk about what is a loan estimate. A loan estimate is normally a three-page documentation that you get from your lender, and it provides you important information, including your estimated interest rate, your monthly payment, your closing costs. It gives you information about, your escrow account, your taxes, insurance, how potentially if your terms will change in the future, like if you go with adjustable rate mortgage, any other specialty features, maybe prepaid penalties, anything along those lines, negative amortization, anything along those lines that falls in regards to the loan that you're getting. It's very imperative that when you get this document, you read through this document, make sure that you understand what you're looking at. If something seems off, does something doesn't seem right, please contact your loan originator. That way, they can go over that in detail, make the necessary corrections. That way, everything is reflecting properly on your closing disclosure. This documentation is due within 3 business days of your confirmed application. So what that means more specifically is that you started an application, check my previous video in regards to the uniform residential loan application. But when you're buying a home, you may complete an application, but you don't receive a loan estimate. You don't receive a loan estimate until you go on the contract and there is a subject property, meaning that, okay, I have identified the home that I want to purchase. I have provided the fully executed contract to the loan originator. And now at that point in time, within 3 business days, you should be receiving your official loan estimate and initial disclosure. What I like to do next is just talk about a little bit about why the loan estimate is so important, why you want to review it, why you want to understand what you're going over. So when it comes to the loan estimate, right, it helps you quickly understand the mechanics of the loan, the terms of the loan, right? Like I said, your monthly payment, your estimated funds due at closing, any accounts that you may need to pay off in order to get your debt to income right, whatever the title costs. Now, what sometimes occur is that you'll see your numbers change from what shows up on a loan estimate compared to what shows up on a closing disclosure. Please understand that this is just an estimate. This is not the final actual numbers, right? But it is what's necessary to make sure you're in the right ballpark and that you're moving in the right direction. There will be revised loan estimates that come out all the way up to the point where your closing disclosure comes out. Once get your closing disclosure, you now know more factually what your final numbers are going to be due at closing. So, how to read a loan estimate? Let me go ahead and get one up here. All right. So, for privacy of this client here, I went ahead and marked out their private information, but we can go ahead and utilize this as an example to really understand what's going on. So first things first, let's go ahead and get my annotates up. All right. So when you're reading a loan estimate, here at the top, it's going to give you the name of the lender, right? So if you're working with a bank or a direct lender, correspondent lender, something like that, you'll see their name up top. If you're working with a mortgage broker like myself, you'll see the representing lender that's going to be that's going to be funding your loan that we're assisting you with through processing. Again, as a mortgage broker, I work with well over 40 different lenders, and 9 out of 10 times it can get you a lot better deal than you can going to your actual bank. Now, going to the next section here, we start the body of the loan estimate and some key details. First is your date issue. Again, your date issue is going to be within 3 business days of your actual loan application. Again, the loan application is a situation where you have completed the loan application and provided a fully executed contract. With those two alone, you should be receiving a loan estimate according to the terms and agreements that you've been talking to or discussing with your loan originator. Below that, you'll see applicant information. The applicant information is going to be your personal information. It'll be your full name along with your current address, primary residence address. Going below that, you'll see property information. This is the subject property or the home in which the loan is going on to. All right, you want to make sure this is accurate, along with every other piece of information in here is accurate as well. Don't want to close on a home that you thought you was getting. Now, this is your sales price, okay? This is the home in which you will agree to purchase at the price. You will agree to a purchase price with the seller utilizing your realtor team. Next, on the right side here, these are your loan terms. This is the number of years in which it's going to take for you to repay the mortgage. The purpose, as you can see, we're focusing in on purchases here. There are also refinances and other type of loan programs, but this will tell you the purpose of you getting the loan. The product type, this is telling you more specifically whether the interest rate is going to be fixed in for the full life of the loan or if the interest rate will be adjusting over the life of the loan. Your loan type here, as you can see, you have your basics, your conventional. This one here is FHA. You also have VA loans, and then you'll have any other specialty products in this box here off to the right. Now, below that, this is your loan ID number. So this is the actual file number, the registered number, so that when you close and you're funding your loan and you're making your monthly payments, this is the loan number that's going to be reflected when you're making your payments. Below that is your rate lock agreement. Now, this one right here is very, very important. Your rate lock agreement basically states whether your interest rate is locked in or not locked in according to the market movement. As you can see here, we are not officially locked in yet. We're waiting on a couple of things to get taken care of, but you want to make sure you know soon as possible when your interest rate is locked in. That way your numbers are more fixed in. The one thing that changes the most, not so much when it comes to title, government recording, stuff like that doesn't really change that much. Even the lender fees don't change that much. What changes most of the time is the market, right? The interest rate, or more specifically, the margin on those interest rate, or the pricing on that interest rate, or the cost to get the rate, or the lender credit, or the credit that you receive to get that rate. That's what normally changes consistently on a day-to-day basis. And that's where we see the swing in the interest rate. People say, oh, the interest rates are going up, interest rates are going down. That's only on the surface level of understanding. What really happens is the cost or the credit on getting the rate going up or down, because all rates exist. 0%, all the way up to 30% or whatever. All rates always exist. It's the cost structure of those rates that changes up or down, or just like when you're buying shares, like an Amazon stock, right? Well, one stock of Amazon is one stock of Amazon, but the cost to get that stock of Amazon is what goes up or down. And that's the same thing when it comes to the interest rate. Sliding down a little bit here, next section we're going to talk about are the loan terms. Now, when we get here, the first thing is your loan amount. Now, this is your total loan amount, with programs like FHA, sometimes with VA, USDA loans, you'll have your purchase price minus your down payment, and then add in the government fee that brings it back up. So again, this is always your total loan amount. Below this is the interest rate that you're actually paying. So you're borrowing X amount of dollars from the lender, and then you're going to pay that principal back plus the interest based off of an annual percentage payback. So there's an amortization calculator, but you'll pay this interest per year based off the balance as you pay it down over time until you completely pay it off. That's a long story short. Below that, you have your principal and interest monthly payment only. Principal and interest monthly payment only. They separate taxes and insurance because taxes and insurance can fluctuate. From one year to the next year, your property taxes may go up or go down. Same thing with your homeowner's insurance. It may go up, it may go down. You may change providers and your premium get better, whatever the case may be. So they normally separate that from the equation when we're talking about principal and interest monthly payment only. Again, principal is the portion of the payment that you make to pay down the balance of your mortgage, and the interest is the portion of the payment that you make that pays the lender for borrowing the money. Below that, you'll see some special features. One is a prepayment penalty. None of my loans have prepayment penalty for the most part, except for like real specialty type of loans. But in most cases, you'll never see anything like this. If you do, basically what it means is that you went into an agreement with the lender stating that you're going to pay the loan for X amount of years, let's say 30 years, right? Well, the lender said, okay, that's fine. But in the first 5 years or 1 year or whatever of this term, you can't pay this mortgage off, period, right? If you do, there's a penalty for it. So that's what a prepayment penalty is. Below that, you'll see a notification whether this is a balloon payment or not. What this means is that you are making your monthly payments, and let's say your monthly payments is interest only, right? You're not paying anything towards principal or little amount towards principal, or maybe you are paying principal and interest. But as you're making your monthly payments, there comes a certain point in time in the term, maybe that's 5, 10 years, or whatever the case may be. And now at the end of that term, there's a lump sum. So let's say, you know, in this case, it's 127,000, right? Well, for the first 5 years, you pay that balance down, I don't know, 30%, call it, you know, give or take. Well, at the end of 5 years, now you have to pay a lump sum of, you know, call it somewhere around $80,000, $90,000, whatever the case may be. You got to pay that in a lump sum or refinance the mortgage or something along those lines. Again, that's just a quick explanation. That's not a factual example, okay? Moving on down here. The next section in which we're discussing and looking at is your projected monthly payment. Now, this is where everything really is going to start to come together, and you know what your total monthly payment is, total monthly payment. So when it comes to the calculation, it'll let you know the year range, as you can see here, and then we see the same number of the principal and interest portion of the payment. And then below that, you have the mortgage insurance. You'll have the mortgage insurance here. So the mortgage insurance, again, it is an insurance policy that protects the lender in case you default or go into foreclosure. This policy is paid out in order to help the lender through the foreclosure process, in order to get the home sold back on the market and cover losses that they receive, because the banks are in the business of lending money, not buying and selling houses, okay? Below that, you see your estimated escrow account. Estimated escrow account basically means property taxes and homeowners insurance, right? Or a combination of one or the two, or multiple insurance, maybe flood insurance is an example that you may have on your property. Once you add all of that up, you get your total monthly payment that you're going to be making. Now, below that, you have your escrow account broken out, right? To better understand. As you can see, the monthly payment here, same payment. So it's telling you what is in this monthly payment. Is it property taxes, the homeowner insurance, is it something other, right, that you're putting in there? And that's the breakdown there. Scrolling down some more. Okay, let's get about right there. So as you can see here, at the bottom of page 1, we have your cash due at closing, okay? Now you have your estimated closing costs, and then you have your estimated cash to close, okay? Now, you're always going to be looking at the situation where you want to look at this, right? What is your estimated cash to close, okay? Now, in this scenario, yes, the estimated closing cost is a little bit higher than the cash to close, because what they deem as closing costs is not inclusive of everything that you need to bring to closing. That's why there's always a difference. To drag your eyes, always right to estimated cash to close. All right, now on page 2, this is your closing cost detail. Now, this is where we're going to start to break down your closing costs. Now, this tends to get very confusing for a lot of people because this is not a normal document that most people are looking at. So one of the things that we want to do is just kind of start going through this. First things first, here you have your closing cost details. You have your discount points in which you're getting the rate. and then you have an administration fee. This is an underwriting fee. Now, every lender is not the same, right? As a mortgage broker, each lender is different for me. So all I can really say here in line number A, or box A is what we call it, box A. This is your lender charges, right? This is straight from the lender in regards to, the discount points, any underwriting, processing, anything along those lines. That is straight from the lender. Below that, we have section B, and we want to go down the left side because that's how it's calculated. So on the left side, you have services in which you cannot shop for, meaning that this is the cost for the loan. It's third-party cost. You can't shop around for this. That's basically what it means. As you can see, you have the cost for the appraisal reinspection fee, credit report fee, closing fee, and the mortgage insurance premium. That's specific to FHA. Again, in this section, it's going to be different according to the lender, the program, what's going on with your specific loan. But what you want to do is understand what's happening in this box. Again, these are services that you have to get for the loan that's forced upon closing that you can't go out there and shop around for. That's specifically all that represents. Below that, you have section number C. Section number C is services in which you can go shop for. And most of the time, the services in which you can go shop for is always title, the title company, right? You can change title companies, you can request a new title company, and so on and so forth, right? But you have to have a title company, a closing attorney, a law firm, or whatever, a closing agent, settlement agent, whatever it is specific to your state and your county. You're going to need someone to file the paperwork, record that with the county, make sure funds are dispersed and all that good stuff. And you can choose who you want that company to be. Now, after that, you have all of the costs tallied up, right? A, B, and C, get your D. All right, now scrolling back up on the right side here. On the right side, we start with our other costs. So in first section here, you have section E, or box E, is your taxes and government fees. Just think local, county, state taxes. That's the easiest way to understand it, right? Each state is different. Each county is different. Again, this is specific to this loan program. I know in some areas, the number goes up substantially. Places like Florida, one of the states that I'm licensed in, I see that a lot. So, just be aware of your tax situation for your area. That way you don't get caught off guard with funds that's needed at closing. Below that, you have box number F. Box F is all your prepaid items. So these are the costs that's needed to be paid at closing to move forward with the loan. One of which is always the homeowner's insurance and your prepaid interest. Okay, you normally always see that. You might see property taxes in there, but you guarantee when you're buying a house, you're going to see a full year's of insurance premium due and then prepaid interest. The reason why you have to pay a full year of insurance is that when you close and fund the loan, you need an insurance policy. And the lender want to make sure it's covered for a full year. And then as you're making your monthly payments, your escrow account is taking a portion of their monthly payment and putting that to the side for taxes and insurance. So that when taxes and insurance are due in the future, from a year from now, they can be paid. But you gotta start it up front. So that's what's happening here. Below that, you have section or box G. Box G has to do with, as you can see, the initial escrow payments at closing, meaning that this is how much money you need to put into the escrow account so that when the taxes and insurance are due in the future, that we're ready to go. So you're going to jumpstart this account by either putting 2 to 3 months or whatever, however many months based off of the calendar year and your county due dates of what's needed for property taxes and homeowners insurance. Now, in most cases, you're going to see this box fluctuate the most, right? Because it's going to be based off of the day or the month in which you close. All right, moving on down. Okay, now getting down to, let's stop right here. Now getting to Box H. Box H normally has to do with owner's title insurance, right? Meaning that when you buy a house, you're getting an additional insurance on the title in case, you know, the title company, when they check the liens and encumbrances and judgments or whatever against the property, it may come back clean. But then there's a hidden lien or judgment that's out there, and now you're the homeowner. So if it comes up 5, 2, 10, whatever years down the line, you're gonna have to pay for it because you are now the homeowner and the lien is against your home. This title insurance will help protect you in case that, you know, there was a lien, a hidden lien placed on the property that occurred 10 years before you even bought the property. You bought the property, you've been living in it for 5. Then it comes up. Insurance pays for that for you. All right. As you can see in line number I, or box I, is just an accumulation of E, F, H, and G. Below that, in line J, you have your line D, which is the left side added up, plus line I, which is the right side added up. And then you have any kind of lender credits based off of the interest rate in which you get. Going down from here. All right. Now, when we're reading through this section here, we're calculating the cash due at closing, okay? Now, again, what the loan estimate does, it itemizes everything, right? Whether you're paying it out of pocket or it's being paid by someone else, you know, maybe the seller or the realtor, or it's being wrapped into your loan. When you're looking at A through J, right, everything is itemized just like a receipt, okay? Now, when you're looking at the calculating cash at close, it starts to be put in this proper perspective. For instance, you have your total closing costs, which is J, which is the same thing we see here, okay? But then we have our financed amount added onto the loan. That's why there's a negative number here. And this negative number of that 2,000 is the same number that's right here, mortgage insurance premium. So we got that 2,000 being reflected. And let me get back here. Okay. And now we have any down payment or funds for the borrower. So, you know, this is your down payment. This is now when you're looking at your closing cost structure, you would have noticed that your down payment wasn't in there anywhere, right? Because again, like I said in my other videos, down payment is not a closing cost. A down payment is your investment into your home, is you converting your cash into equity, right? So they're not putting it in the closing cost section because that's not what it is. But it reflects here because it has to do with your total cash due at closing. You see how the variation of the word is different? Cash to close is different from closing costs, totally two different verbiage. Below that, you have any type of the deposit or earnest money is the wording for it. And then any other credits that you can see there. Funds for the borrower might be any funds that you get maybe from the realtor partner or something like that. Any seller credit, this is the seller giving you any kind of credit, or any other adjustments or credits that you may get, maybe a gift of equity or something like that, right, through the transaction. So you have all that, and once you do your adding and subtracting, you get your estimated cash to close, which again is the number that we saw up top. Now, if we go back, it's the same number that we see here, right? But if you take into account the fact that your upfront mortgage insurance premium is credited or is credited to your cash to close or added to the loan at closing, and then your down payment, which is not reflected in the estimated closing costs, it starts to make sense why your cash to close is higher than your estimated closing costs. All right, so that's the end of page 2. So we're just going to page 3. Now in page 3 here, this again, as you can see here, this is just additional information. You have the lender information on the left side. You have the mortgage, as you can see, the mortgage broker who I work with currently, Mortgage Edge Home Finance Corporation. There's my personal information, identification, stuff like that for the state of Georgia and federally. And then below that, you have your comparison chart. Now, I've seen people cancel their loan because they were confused with the comparison chart. So I just want to kind of explain this to everyone. When you're looking at your comparison chart, this is just to help you understand what's going on with interest, principal and interest, right? The biggest fault is always the annual percentage rate. So let's go through all three of these to make sure we understand what we are looking at and why and how to understand it, okay? Now, when it comes to in 5 years, okay, it says $58,365 total you have paid in principal, interest, mortgage insurance, and other loan costs. So what it's saying here is that it's taking your payments that you're making for the first 5 years of the mortgage, and it's estimating that out of your principal portion of your monthly payment, your interest portion of your monthly payment, the mortgage insurance portion of your monthly payment, and the loan costs that you paid at closing, all four of these numbers, right, adds up to that number that you pay in the first 5 years. Then it takes, okay, this is the amount of principal that you paid off. So in the $58,365, $9,238 is principal. That's what it means exactly. Below that, you have your annual percentage rate. Oh, sorry about that. Did it again. Sticky fingers. All right, we'll just do it like that. That's close enough. You have your annual percentage rate. Okay. Now, when it comes to your APR, as it is most commonly termed, this is, as you can see, your cost over the loan term expressed as a rate. This is not your interest rate. So what does that mean? Well, APR has to do more specifically with any cost that you have to pay on the lender side to get the loan, right? It has nothing to do with the title, government recording, escrow, taxes, and insurance. This is all lender, and only lender. Now, when you're looking at that, it's taking the cost, so the upfront mortgage insurance premium, or more specifically, let me scroll up. Let me show you more specifically. All right. So if we scroll up here, the red's still there. So anything that shows in box A, right? And certain things that shows in box B. So anything shows in box A, certain things that shows in box B, and then over here in box F, just the prepaid interest, okay? So those three, again, everything in box A, certain things in box B. In this scenario, the mortgage insurance premium is a thing that's more specific. And then on F, prepaid interest, because that's interest that you're paying is prepaid. All of that added up together, and then it is converted into an interest rate based over the life of the loan, so the full 30 years, and then they convert it into an interest rate. Now, so that's a whole lot of numbers that's moving around. So when you're looking at one lender to the next, the APR is going to always be different, because not every lender charges the same thing or reflect their charges, okay? Not every lender is going to be using the same date of closing, and so on and so forth, right? If you're looking at a different loan program, right? If you're looking at ABC Lender over here, and ABC Lender is quoting you an FHA loan, and you look at that APR, and then you look at XYZ Lender, and they're quoting you a conventional loan, and you look at their APR, the APR over here may be better at XYZ than it is over at ABC, but maybe ABC loan is actually better for you financially, and you getting the loan. So the APR tends to get confusing, especially when it comes to a consumer aspect. My thing is always the APR is just a conversion of the numbers. So pay more close attention to the breakdown of your closing costs, page 2, and your actual interest rate. When you pay more attention, pay closer attention to that, then everything starts to make more sense. All right. Now, moving on from here, let's get these cleared. All right. Now, below that, we have total interest percentage, So let's read what that is. The total amount of interest that you will pay over the loan term as expressed as a percentage of your loan amount. So what they're saying is the amortization calculator is taking, okay, from day one or month one to the last month of you making your 30-year mortgage payment, so 360 payments, okay? They're taking the interest portion of that payment and adding it all up, and then they're using they're dividing that by your loan amount, and it's giving them a percentage. So in this scenario, what it's saying is that um, if you make your monthly payment, just your minimum monthly payment over the full life of the mortgage, you'll be paying 110% more for interest. So so in this scenario, the loan amount is like 127, right? So 127 times 110%, right? So that's basically what we're talking about here. It just shows in a comparative nature how much in interest you're paying versus how much principal you're paying. It's just a comparative nature. All right. Now below this, we have other considerations. This is just extra information. Appraisal, we may order an appraisal to determine the property's value and charge you for this appraisal. We will promptly give you a copy of any appraisal, even if your loan does not close, because when it comes to appraisal, that's a third-party charge you pay out separate from closing. So you own that appraisal report. That's your appraisal report. You can pay for an additional appraisal for your own use at your cost. So if you don't like that appraisal, you go get a different appraisal. Sure, great, good for you. But it doesn't change the loan terms because it has to come through a third party or an appraisal management company. After that, assumption. If you sell or transfer this party to another person, we will allow, under certain conditions, this person to assume the loan on the original terms. So what this particular loan that I'm setting up for my client is that, okay, if she decides to sell this home, right, the new buyer could go about qualifying for the same loan terms that she has. So this is a great scenario when interest rates are going up, right? When rates are going up and now a person's going to buy your home, well, you could give them the same original terms of the loan. Now, of course, you want to get your difference, but it may make sense if they can assume the loan, especially if you're doing it for a family member. I see that a lot. And then, of course, if it's checked no, they will not allow assumption, meaning that the new buyer has to fully qualify. Or let's say in a scenario where you transfer the property, right? So you own this home and you're making your monthly payments and you want to transfer the property to your children, right? You want to just give the home to your children, your grandchildren, or any significant other, whoever you care about, your loved one. Well, you can do that and they could qualify for the same terms and conditions that's already on the home. That's what assumption means. Other than that, homeowners insurance. This loan requires homeowners insurance on the property, which you may obtain from a company of your choice that we find acceptable. At the end of the day, it's saying that you have some insurance on this property in case, an act of God happens, fire, flood, hurricane, tornado, whatever the case may be. Have some insurance just in case that occurs. The house get blown away, burned down to the ground. Well, the insurance premium will pay out the mortgage, right? Or pay the replacement cost of the home, or whatever the case may be, and that we're covered as a mortgagee on the policy. Under there, you have your late payment. Your late payment, normally after 15 days, they consider it late. As you see here, it charges 4% of the principal and interest due. That's the monthly payment, principal interest of that monthly payment. They're charged 4%. Each lender is different. It may be 5%. It may be the date of the 10th. It can be anything, but take the time to read the late payment. That way you fully understand what's happening with your mortgage and you can plan accordingly when it comes to your payroll. Refinance. Refinancing this loan will depend on your future financial situation, the property value, so on and so forth. Now, the lender may have something different, but most lenders are always going to say, if you're going to refinance, you're doing a brand new loan and you need to qualify for that brand new loan. It may be a full documentation or alternate or limited documentation, meaning that, you got to show all your income or maybe no income, depending on the program, right? But it's saying that you got to qualify for that loan at that time. And then servicing, right? So when it comes to servicing, this is when you start to understand, okay, um, what's going to happen with my loan after closing, right? And in the scenario right here, what I'm meaning is that when we close and we fund your loan, the lender that's represented at the top of the loan estimate will be the same lender you're going to make your monthly payments to. Now, if that lender is not, it'll say here, we will transfer servicing of your loan, meaning that, oh, as soon as we close and fund this thing, we're going to transfer you to another lender, right? So servicing will tell you exactly what's going on with your mortgage. Below that, you'll just confirm your receipt, and then you just have your service providers list. What this does, and it's nothing more any specific, but it just starts to just providers, give you providers information, contact information. You know, you can select these providers or shop for your own. We're just providing people that you can work with. Maybe you need to get a pest inspection. Maybe you need to get a survey. Hey, here's a name and number and email for those third party contractors where you can reach out and get the services needed, or you can just go do it yourself, right? That's really what's all that's going. And as you can see, that's the end of the loan estimate. Again, I hope it was some great information here. I hope that now the loan estimate, after us reviewing it, is more clear, is more understood. That way, you know what you're getting yourself into. I know we're not all numbers people, we're not all legalese type people, but when it comes to home ownership and buying a house, you absolutely want to understand the loan estimate. You absolutely want to understand the loan application. And then I'll be doing another video on the closing disclosure. You absolutely want to understand the closing disclosure. These three forms of documents, and don't get me wrong, when you're going through the loan home buying process, you may see 80, 100, 150 documents, depending on the lender that you're working with. So, but those three documents are very imperative to you knowing exactly what's going on. That's required under federal law. It's been wonderful. It's been great. Please like, subscribe, share this video, tell your loved ones about this channel here. Check the description. I'm adding more and more information. You can reach out to me with a free consultation. My book is in the middle of finalizing publishing, so I'll get that up. You can join my Facebook group, follow me on my Facebook page. I'll include more of my social media accounts as I grow them out and put more and more content out. But the biggest thing that can be grateful for me and helpful is please leave a comment. All comments are welcome, right? If you got any questions, you got a scenario you want to run, let's say you're in the middle of a home buying process, refinance process, and you wanna review your loan estimate or closing disclosure, we can go live, of course, with your consent, and we can go through it and break it down and help you do it. Or if you want to do it private, that's fine as well. But I'll be putting more information in there, and I'll be back with more information soon. Good quality content for you, and I wish you all the best. See you on the other side of home ownership. Mortgage Sensei out.